If you don't have doubts about the strong market and the economy, probably will after today's show.
People think that lower rates are good, but in fact, I don't think they're good at all from here. And frankly, how much of the economy is good because people that were making, 50 basis points 5 years ago are now making 4% on their money. And that money is then being spent, right? That wasn't being spent before. So if you lower rates too much, you're going to lower people's incomes.
That's David Ellison of the Hennessy Funds, and he thinks that the response to rate cuts could tank the market and in turn the economy. And Steve Cucchiaro of 3EDGE Asset Management, he sees Ellison on the muddled impact of rate cuts, and he raises him an epic valuation problem.
The way we measure valuation right now, there are three major periods of overvaluation in the last century. And we think this is one of those three. So we think the market is much more dangerous than most people will ever admit.
We've got those two, plus Todd Rosenbluth of Vetify with his ETF of the week. Welcome to Money Life.
It all starts here.
No need to whisper that it starts here. It's great that we've got you here to join us because we have a terrific show planned. This is Money Life for October the 23rd. And yes, you are going to hear some things that could be alarming. But even as you hear them, they will not be saying get out of the market right now. That is distinctly not what is going on. No. It is much different than that. It will be all about ride this while you can, but look for where the turning point is coming. That's what we've been hearing a lot of. It's certainly not bad advice because we've seen a lot of things that the market got convinced of, and I don't think anybody's truly convinced. I don't think there's full consensus. And the market, Wednesday, a little rough patch, I guess, but it's not hard if you're reading commentaries, et cetera, for folks to say, yep, the rally's coming back. It's not done yet. So rallies don't go straight up. You shouldn't expect them to. And rallies don't stop just because you've reached record highs. You shouldn't expect that either. But the question is, when the back away comes, what's it going to look like and how long can we wait? Because, everything that is an outlier, every time we've ever had a period where, it's never done this before, and then it breaks it. It's kind of like all the records, when I grew up, there were numbers you knew in the sports world that they were all the things that like this record will never be broken. And many of them and most of them have been broken. And so nobody ever did it before. And then the one guy got further in. That's kind of what the market does too. I'm Chuck Jaffe, financial columnist, your host here on Money Life. This show is independent personal finance talk. And a show like today where, frankly, we could have called either one of these guys, David Ellison or Steve Cucchiaro, the big interview. We call one the other interview, whatever you want to call it, the kind of opinions you want to get. And if you've never heard of these guys before, well, I do understand that when we have a big name or a bigger name where you're going, yep, I recognize this guy, that makes it easy. But I think that the real art in what we do is that we bring you a lot of really qualified, knowledgeable voices, and you get to then figure out how it's all working. I will say I am stunned that I got much less pushback on the political discussions we had in terms of political investing than I expected to get this week. Maybe you guys are late getting to the shows or something along those lines, or maybe we kind of did it. We talked about methodology without getting dragged into partisan politics. I would hope that was the case, but I'm always curious as to what you think about the show. Right now, I know that we need to get started because if we don't, we're going to run long. Again, today's lineup, Todd Rosenbluth, David Ellison, Steve Cucchiaro. These may not be the good news, happy-go-lucky interviews you are hoping for, but they will make you smarter. And it starts with the ETF of the week right after this message.
Exchange is more than a finance conference. It's a community. The insights, connections, and strategies you'll gain will last long after the event ends. Join us for the most valuable few days of your year. Exchange 2026, March 15th through the 18th in Las Vegas. Visit exchangeetf.com to register now.
One fund on point for today, the expert to talk about it. This is the ETF of the week. Welcome to the ETF of the week, where we get the latest take from Todd Rosenbluth, the head of research at Vetify. And if you go to Vetify.com, you'll find all the tools you need to be a savvier, smarter ETF investor and to get more details on the new, newsworthy, trending, and timely ETFs that we discuss here. Todd Rosenbluth, it's great to chat with you again.
It's great to be back, Chuck.
Your ETF of the week is
The Direxion Daily Semiconductor Bull 3X Shares ETF, SOXL.
SOXL, the Direxion Daily Semiconductor Bull 3X Shares. Wow, Todd, this is not the kind of thing I normally expect to be ETF for the week, because 3X means we're playing leverage, we're sector fund, and we're daily. So there's got to be something that's the bee in your bonnet on this one. What's up?
Well, it's spooky season, right? People are going to be listening to this and watching this as we're heading into Halloween season. I figured I'd come up with one of the ETFs that people think is quite risky and scary, and maybe we'll spend some time talking about what it is and what it isn't. So SOXL is actually one of the oldest of those leverage ETFs. It launched in 2010, so we've got 15 years of history behind it. We've seen single stock leverage ETFs increase in number. We actually saw a filing in recent weeks of 5 times leverage that got people curious, scared, a bunch of those adjectives. Let's talk about what XOL is and what it isn't.
What it is volatile. In 2023, the fund was up about 225%. In 2021, it was up 118%. In 2019, it was up over 230%. And I know that in the last 10 years, it's had like 6 years where it's been up more than 100%. And this year, it's up more than 55%. But it also had an 85% loss in 2022. It was also down about 12.5% last year when the market was strongly positive. So what is it, or maybe what should it be used for?
The word daily in the ETF, I think, is perhaps, there's lots of the words in this name of the ETF, but it's particularly important. It's daily in terms of the leverage standpoint, and it's also daily in the way that investors should consider it. So you cited a lot of annual numbers, and they're relevant because that's how we look at ETFs typically. But I don't think many people, and in fact, I don't think people should be looking at this leverage ETF or any leverage ETF for that long a time horizon. To me, the use case for SOXL is we are in earnings season. Right now, as we are recording this, as people will be listening and watching to this, we are in earnings season. Individual stocks within the semiconductor space and the semiconductor space at large is going to move. Are you bullish on that heading into earnings for a day or two? This is a trade that makes sense, perhaps, for you to put on, bearing in mind that you could be losing. So the fund has done well this year, SOXL, from a performance standpoint and years past, but it was just a couple of weeks ago. We had fears about the US-China relationship, and SOXL was down close to 20% on that given day, on the day. So these are risky if you get the call wrong. If you get the call right, they're very rewarding. And so it's important to both think of it from understanding the risk, but also understanding that time horizon and keeping it tactical.
That being the case, a fund like this is not only not for the faint of heart, it is for somebody who is ready to watch it and be trading in and out. Like, you can't take a day off. You can't buy this fund and not be making your decision on a day-to-day basis, correct?
Correct. Or you do so with bearing in mind that you could be losing any of the profits you might have gained or profits you hadn't yet had a chance to be able to gain. It's okay to not watch this on a daily basis as long as you're prepared to stomach the losses. And I think it's important if you are investing, and many of the listeners we've come talking about things from a strategic standpoint. I think the last one or last two we talked about were more strategic in nature, how you could have an ETF be part of your portfolio for the long haul. SOXL and its sister fund, which is SOXS, which is the bearish version where you're betting against the stocks and you actually hope that they go down in value, are tactical short-term trades.
For somebody who is out there who has long-term trades in semiconductors, or who has long-term trades in the S&P 500, which has significant technology and semiconductor exposure, normally we're saying you factor that stuff in. This time, that's really irrelevant. You want to have that long-term stuff. You're not really worried about the weighting because this is in that tactical short-term in and out of the market kind of piece of the portfolio. So the bigger lesson here is if you're going to be playing with this, don't muddy the waters. Keep this as a completely separate part of your portfolio, right?
Yeah, so this is putting some gravy on top, or my friend Eric Balchunas likes to use the phrase hot sauce on top of what you're putting into your portfolio. So you likely own semiconductor exposure through the S&P 500. NVIDIA is the largest stock. NVIDIA is joined by AMD and Intel and Qualcomm. These are other semiconductor stocks that you'll have within the S&P 500. If you own the Qs, you are exposed to semiconductor stocks. If you're buying SOXL for a short-term purpose, it's because you believe now is a great time, now being the day you're listening to this or the day after or whenever you put the trade on for that short-term time horizon, and you're prepared for that snowball effect to go in favor as opposed to working against you.
This is part of a suite of funds. You could have picked other industries, etc. For somebody who is making this kind of play, if they get comfortable doing it, do they stick in one or do they kind of go, no, if I've got a sense that today it's semiconductors and tomorrow it's industrial companies or whatever it might be, yeah, you're dancing around because that's what these are designed to do.
Right. So the approach to take a leverage bet on a sector or industries or the broader marketplace, Direxion has a suite of those products. They're not the only one. We've also seen individual stocks that are leveraged. You lose the benefits of diversification in that I guess you can be much more precise and choose an individual company, and thus the company will benefit. But I think you get the benefits, some benefits of diversification by focusing on semiconductors. I would note that Direxion launched recently a top 5 bull ETF for semiconductors, a daily semiconductor top 5 that gets more concentrated, whereas SOXL is going to hold more than 5 companies, but all of the companies that are in the broader semiconductor index. It's really, I guess, a choice. But the narrower your focus is, the greater the risk that you're taking on, potential greater reward. But I want to make sure that we focus on the risk. Even though I'm highlighting this ETF, SOXL, as an ETF of the week, this is a risky investment. This should be a slice of your portfolio. This should be done with a short-term time horizon in mind, and you should be prepared that you could lose money on day one more than perhaps you had expected.
It is a pick that can do some spooky things, but it could also do some great things. It's SOXL, the Direxion Daily Semiconductor Bull 3X Fund, the ETF of the week, an unusual ETF of the week pick from Todd Rosenbluth at Vetify. Todd, great stuff as always. See you next week.
Happy Halloween, Chuck.
That's Todd Rosenbluth. He's the head of research at Vetify. Go to vetify.com to get more information on the funds we talk about or the ones that are in your portfolio that maybe we haven't talked about, but which you want more information about. Todd, of course, kicks us off every Thursday, and we have just started this show. Up next, I'm talking financial services with David Ellison from the Hennessy Funds. And then Steve Cucchiaro from 3EDGE will be here talking gold. We're living the money life, and there's much more to come.
Everything an advisor needs in one newsletter. Go to advisorperspectives.com and see why 100,000 advisors are subscribed to our newsletter.
We start today's interviews with what we call the other interview on this show, but really, they're both big interviews today because my guest is David Ellison. He's portfolio manager at the Hennessy Funds. He runs the Hennessy Large Cap Financial Fund, that's HLFNX, also Hennessy Small Cap Financial, HSFNX. You can go to HennessyFunds.com for more information. But seriously, when you guys write me and say, oh, I want to hear more about banking in the financial industry, this is the first person I'm going to turn to. And he has been in my career as a journalist for decades. David and I have been talking for literally decades. We've done this for a long time. And there is nobody I would rather talk to when it comes to what's happening in the financial services sector than him. So let's get busy. David Ellison, it's great to have you back on the show.
It's good to hear your voice, Chuck.
We have done this for a long time. Like I said, I'm not calling us old, but we've done this for a long time. The conditions we are seeing now, people want to make them out as being unique, but do they remind you of something? Are we humming a tune that we have sung before, or are we literally seeing the dangerous, this time it's different kind of situation?
Well, I think if you look at the overall market, obviously the valuation metrics are at the high end of historical ranges. The number of companies that are unprofitable, that are doing well or have gone up a lot is at the high end of the range. And that's well talked about and well understood by a lot of people in the business. There's nothing new about what's happened here. The issue is sort of the trying to find out where the risks are in the system, and then understanding those risks, and then making a judgment as to whether you want to avoid those risks or just be mindful of those risks. And I think the struggle here is, for a lot of people, is that historically, at least in my career, which goes back to the early 80s, all of the big downturns in the market have been driven by a reversal in liquidity or an increase in bad loans, let's say at the banks, that has created a liquidity problem, and then the market becomes the primary source of liquidity for the market, because you can't sell your house, you can't sell bonds, so you just sell equities at whatever you can get, and that gives you the liquidity to get to the other side. And right now, the banking industry is in historically very good shape from a capital perspective, from a credit perspective. Obviously, the Fed is paying attention to liquidity conditions. They appear to be on a rate cutting cycle, so that will ease conditions. So we have a situation where the market is high, and nobody really can see their way to a liquidity problem that then would create this downturn in the market. And so everybody's looking around and saying, what's the thing that's going to happen? And we don't have that historical risk where you have the banks, 50 times levered into no doc liar loans that are all going to go down and be a real problem. You just don't have that this time. So that's the difference from, let's say, the historically perspective that I have anyways, being in the business.
I understand that you, like every other investment expert I talk to, your crystal ball's not actually working. But if you had to guess, especially when it comes to the financial services industry, like what winds up taking you from where everything is functioning well and it seems like we're rolling along to where we get to the next stumbles, what are you worried about? What's your nightmare here?
There's a number of things to look at. One, you've had a significant increase in international investment in the U.S. stock market. And those people are, in a sense, outsiders that have bought into this market. And if they decide to exit the market because their home markets look better or other markets look better, that's a source of selling pressure that is not American, it's foreign. And so that's something that I'm looking at is sort of something to be concerned about, because there's been such a big increase in the foreign holdings of U.S. equities. I think the second thing is really mental and sort of a societal thing and sort of an emotional thing. We have such a biblical belief in AI and the related things around it, whether it be stable coins or Bitcoin or all of this sort of electronic money, electronic AI stuff going on, and all the money that's going into AI and all the hope and the promise, and everybody's trying to get ahead of that and get on top of it and buy the stocks that are going to really explode because of the AI implementation on top of all of this other electronic banking stuff that's happening. And I think if there's any sort of throttle back in terms of the hope and dreams of that, that's an area where the market could correct a bit. And I'm not talking about a big correction, just I think there's many, many companies out there that have very high valuations, don't have profits, have very little revenues, and those stocks are vulnerable to a sort of a change in the belief system around AI and stable coins and fintech and that stuff that's kind of circling out there. It's the great disco ball now. And if it stops rotating or the lights go out, that's going to be a problem.
As a money manager, you and I have talked in the past that the times when it's best to invest are not always the times when it seems best to invest. I've had guests on the show who are not specialists in the industry. A couple of them have really loved financial services and have been leaning in. A couple of others have said, yeah, with a rate cut environment and what have you. So where are you in terms of just how good is this environment? You've invested in plenty of good markets before. Where does this one stack up in terms of where conditions are?
The financial industry is in very good shape relative to credit and capital and earnings and their ability to invest. You've got some deregulation going on. You've got M&A happening. I think there's a belief in the banking system that they are still afraid of credit, which I think is a good thing. You've got Jamie Dimon, who is sort of being very conservative in his talks to the public or to the earnings calls, and that obviously is permeating through the whole company. So I think from a structural point of view, the banks are in good shape, and that's why the market is where it is. Companies don't trade at 10 or 20 times revenue when they think there's going to be a liquidity problem out of a big bank. And so those valuations are reflective of a stable, safe financial system that has benefited from good credit underwriting and decent liquidity development, decent liability structures. And so I think the question now is, are people, the banks are a safe place because you're going to generally have rising earnings. You've got the Fed at your back. They haven't taken the credit risk. And so I think it becomes a safe investment as opposed to something that's going to be, a 10 bagger because they're going to adopt some blockchain technology and go up tenfold. That's not the story with financials. The financials is it's a safe place to be, and they're safe, which makes the market safe, which makes bonds safe, and the whole system safer, which is why we have the market we have, and frankly, the economy we have.
Speaking of the economy, we've got a Fed that most people think is committed to continuing interest rate cuts, even though we've got a market at record highs and some other things that would suggest that maybe it's not entirely necessary. Do you think we will get the rate cuts that the market is expecting us to get? And will we get the impact? Because if we're cutting into conditions that we don't normally see cuts, do we get reactions that we don't normally see as well?
It's a good question, and it's a frustrating question because it doesn't appear that the rate cuts are needed. And then the question is, well, why are they cutting rates then? So you look around and say, well, what's there that we should worry about? To some degree, the issue is the market as good as it is because the economy is good, or is it the economy as good as it is because the market is where it is? And so I think the big question is, if the market goes down 20% and people are worried about it, is that going to affect the economy, or is it the other way around? And I think the concern is that the market is becoming the economy. And if the market were to go down, it would be a big problem for the overall economy because you would lose liquidity, you would lose the wealth effect, and that would really damage the economy more than it has historically. And I think that's what everybody's trying to figure out. And I think the wealth that's been built up in the market over the last, even just 5 years, if you were to take that away, what would happen? And so the Fed is saying, we don't really want the market to go down that much, if at all, because it would really impact financial conditions in a negative way, more so than it has ever done historically because of what's happened the last 4 or 5 years.
We're going to see rate cuts, but of course, things like mortgage rates and all the banking activity there is tied more to treasury yields. Rate cuts don't really have that impact. What's your forecast on what's happening with the treasury yield, and what is that going to do? Will we wind up seeing the mortgage situation change dramatically to create new opportunities?
In my view, there's a frustrating sort of narrative that, lower rates are good. If everybody had their way, rates would be at zero. And to me, that's not healthy. And I think that this idea that, well, rates will go down, mortgage rates will go down, home prices, people will be able to buy homes. No, home prices will either stay where they are or go up. So net, the buyer of the home is not going to benefit from lower mortgage rates because whatever the lower rate is going to be offset by a higher price. And so it doesn't make any sense to do that. I'd rather have mortgage rates at 10% and have home prices where they were 5 years ago. It's the embedded investment that is so high now relative to sort of your income. And so I think that's the problem, is that people think that lower rates are good, but in fact, I don't think they're good at all from here. And frankly, how much of the economy is good because people that were making, 50 basis points 5 years ago are now making 4% on their money. And that money is then being spent, right? That wasn't being spent before. So if you lower rates too much, you're going to lower people's incomes. So why not have Apple pay 5% for debt and give it to me so I can spend it, rather than Apple pay 1% and I have no income, but Apple has all the benefit of the zero rates? To me, it makes no sense to this idea that lower rates are the elixir for everything. It's just the media wants it because they want something to talk about, and they think the market's going to go up because of it. And I think that's a mistake, but that's where the politics are, unfortunately.
Yes, it's not just the media, it is the politics. And given that, and a market that we know cannot stay at record highs indefinitely, it can't go to the sky without some sort of a breather. Do you worry that, we're going to have rate cuts, and into it, we're going to have the market finally getting exhausted, and oh, by the way, here's the recession that we've been waiting, that we're going to be in an environment where rate cuts, rather than helping to get us out of recession, could lead us into it or be part of what's happening right as we go there, leaving us with nothing really in the toolkit to help get us out?
I think that's where we are now. I think the issue is that, to what degree is the market being propped up by foreign investors and the 5% of the Americans that have money? See, the issue that I have is that you have 60 to 70% of the population in this country that don't own the market. So do we really care about the people working, making, $100,000 a year or less? If they get in trouble and lose their jobs, it doesn't matter to the investor type because they don't have stocks to sell. They don't have bonds to sell. So I don't care about them. All I care about is the top 5% that own all the equities, or whatever the number is, some crazy number about the concentration of the number of people who own equities. And those people are going to benefit from potentially the tax cuts and all the other things. They don't care about inflation. All they care about is the market going up, because that's where they're invested. And so you really don't have a lot of people that are benefiting from the stock market. And yet it's the one thing that people think is so important. And so we'll see what happens. But I think that's the shame of it, is that the bulk of the people in America are not benefiting. They don't own it. And those people who own it don't care about the people that don't own it.
It creates all sorts of interesting and difficult dilemmas, which the market will eventually wring it out of somebody, if not all of us. David, I got more questions. I just don't have more time, but this has been great. I hope you'll come back and chat with me again soon. I know you will, because we've done this so many times, but I look forward to the next one already. It's
good to chat, Chuck. Until next time.
That's David Ellison. He's portfolio manager at the Hennessy Fund. Specifically, he runs Hennessy Large Cap Financial, HLFNX, Hennessy Small Cap Financial, HSFNX. You can learn more by going to HennessyFunds.com. And you can learn more by sticking around on Money Life. Up next, Steve Cucchiaro from 3EDGE will be here. Focus is going to turn to gold when we come back in a moment.
Looking to earn CE credits and hear from top portfolio managers? Go to etftrends.com/webcasts and learn more.
Welcome back to Money Life, where it's time for the big interview on the October 23rd show. Returning to the show today, Steve Cucchiaro. He is Chief Executive and Chief Investment Officer at 3EDGE Asset Management. If you want to learn more about the firm, you want to check out some of the stuff they've written up on the investment world, etc., it is 3EDGEAM.com. Steve Cucchiaro, it's great to have you back on the show.
Great to see you again, Chuck. Glad to be here.
I'm excited to talk to you because functionally, what brings me to have you back on the show was that 3EDGE recently released a white paper on gold, where you were talking about how gold should properly be used as a diversifier. And right now, well, everybody's looking at gold and going, you know, how high is it going to go? How quickly is it going to get there? And how much do I want? So let's try to answer some of those questions. But let's start with the role that you think gold should be playing in a portfolio versus the role you see it playing for people right now. Because I think a lot of people are not necessarily using it the way you think they should.
That's right. So there are a number of people who are investing in gold as an individual asset. They see it go up, they like the trend, they jump on the trend, just like any other asset, where our preference is that gold plays a very special role within a multi-asset portfolio. Often gold does well when both stocks and bonds do poorly. So many people only own stocks and bonds, and then they are vulnerable when the conditions come along that hurt both stocks and bonds at the same time. And that's usually precisely the time when gold does well. Stagflation is an example.
I'm old enough to remember when people would keep 5 to 10% of a portfolio. Realistically, it was 10% until gold kind of stunk it up. And then it was 5%. And then it was, yeah, if you wanna, you can have an allocation to gold. And then gold got better and it was like, oh, 5% sounds good. And now it's getting away from the you should have a static asset allocation to gold. How often would you be rebalancing on gold? And how much of a portfolio would you let it be since you're using it strategically?
So we use a range, and the bottom of the range is what we call a strategic asset allocation. No matter what's going on in the world, no matter what our projections are, we always want a minimum of gold in the portfolio. We've done countless simulations over the widest variety of conditions and market cycles. And we've concluded through all the optimizations that portfolio should have at least 4% in gold as a baseline. And if it goes below that, you rebalance to the 4. Now, our range goes from that 4% up to 20%. The difference depends on our view of the market dynamics, the cause and effect relationships that affect the global markets. And if we go up to the maximum and we find out that the market action takes us even beyond that, it's very important to rebalance back to that. And those are usually the times where you're glad you did, because when it gets really up at the top, you get into profit taking and you're glad you rebalance.
Obviously, portfolio decisions are very individual and it's not as simple and blanket as this is what it would be at any given time. But how close are you to those upper limits right now in a lot of portfolios? The 4% doesn't seem like it's holding when gold's going up this hard.
That's right. So we are not at our minimum. We are not all the way at our maximum, but we're pretty close. Depending on the risk-adjusted return of the portfolio, we're at 15% for a moderate portfolio, and for our aggressive portfolio, we're at 10% for our conservative portfolio. And we feel that gives us enough of the hedge we are looking for, and without being overly vulnerable to a market that might be subject to some profit-taking near term because it's just gone up so far so fast.
Let's talk about that. We are in a market that has been at record highs, both for the equities and for gold. There is a lot of talk about what kind of bubble conditions we might be inflating, but you can wait a long time until a bubble actually pops. You can be inflating it for a while. So on the one hand, as you say, you're going to ride with it and see what happens. Have you got a number in mind about what gold's potential is at this point? And then the secondary side of that question is, have you got a trigger in mind for what will finally make it that we have the step back that you think is going to happen?
So in terms of the trigger, our model will calculate what we call an overbought condition. And if the gold price goes up too rapidly within too compressed a time frame, it will calculate the likely threshold beyond which you really should take profits, and it's very vulnerable to a correction. And we got to that point very recently, or very close to that point. So there is a trigger that way, but it's not a simple formula, and it doesn't stay the same all the time. It depends on a lot of other factors. So it's constantly recalculating what that trigger might be. In terms of what is the correct price, sometimes people think of gold as an individual asset that has a price that goes up or down. I'd like to flip it around and say that gold is an asset. Investable gold is a bar of gold that sits on a shelf for thousands of years. It doesn't get shinier, it doesn't get duller, it doesn't produce interest or dividends. It's the most stable, inert, unchanging asset we have in the investment universe. So think of the gold price more as the value of paper money, because you always trade gold at that price for paper money. So it really reflects how people feel about paper money.
What is driving their feelings about paper money right now, in your opinion? I mean, gold has not been a great inflation hedge in this market. It's been a great geopolitical hedge. For gold to normally work as an inflation hedge, we need inflation that's even higher than what we've seen for longer than we've seen it. So it hasn't functioned there, but it's been a good geopolitical hedge. But is this a statement on politics or how the world sees our politics and what's going on right now?
Sometimes people confuse gold as an inflation hedge. It really acts as what I would call a monetary inflation hedge. And it's an excellent predictor of inflation 2, 3, 4 years down the road, but not of coincident inflation that's happening today. So, for instance, people anticipate central bank, or in our case, Federal Reserve Board, is going to have a very easy stimulative monetary policy. That's very bullish for gold. Now, what really got this rally started was when the Ukraine war hit. We produced sanctions. And at that point, the central banks around the world said, uh-oh, we have most of our foreign reserves in US treasuries. And now the US government shows that they might put sanctions on the very assets we hold. Maybe it's time to swap some of those US treasury paper assets into gold. So we saw a huge surge in buying from central banks. And that's what got the rally kicked off. The retail investor wasn't involved at that time. It was really the central banks. And then as time went on, people worried about stagflation. And stagflation we haven't really had since the 1970s, but stagflation was a period where hard assets like commodities and gold did tremendously well, and stocks and bonds suffered for a whole decade, didn't even keep up with inflation. So that was another factor. Third factor is we've got soaring government deficits. The debt level relative to GDP is just about as high as it was back in World War II days. And we're not in World War III, knock on wood, hopefully yet. So people are very concerned about the debt levels. And what that means is, oh, maybe the government's going to come in and do what they did after World War II, financial repression, hold interest rates artificially low, below the rate of inflation, impose a hidden tax on the bondholder. And boy, that would be great for gold. Or we've heard about threats to Fed independence, that Chair Powell's his term expires in May. And maybe we put in someone who's going to drive interest rates very low, lower than they normally need be. And then that's going to cause inflation down the road and weaken the dollar. So there are many reasons why gold has been doing well.
You talked at the beginning of that answer about how gold is an excellent predictor of inflation down the line. That being the case, with gold where it is right now, what are we expecting this to mean for inflation down the line? If gold is at these prices, what is inflation going to be a couple of years from now? Obviously, knowing that the Fed's going to try to impact it one way or another.
So we're in an inflation cycle today that has an analogy with the inflation cycle that we were in back in the 1970s and also back in the 1940s. All three of those inflation cycles started with a low rate of inflation. Inflation seemingly came out of nowhere, hit a high level, and then started to fall. After it fell in all three cases, today, 70s and 40s, everybody declared victory on inflation, and it was premature. And all the same forces were still under the surface. And in all three cases, there's been this declaration of victory on inflation. There's been a relaxation of fighting inflation. We just heard the Fed in the last couple of meetings say they're going to focus much more on supporting employment than they are fighting inflation. And it's built into the market. We're going to get more rate cuts very soon. And that's precisely what happened in the 70s and also in the 40s. And then we got a second wave of inflation that, again, no one expected. And the second wave peaked even up above the first wave. So I think it would be very premature to declare victory on inflation. And especially if the Fed loses independence, especially if the Fed comes subservient to the Treasury to try to help fund the enormous deficit in the supply of Treasury bonds we're going to have to issue, I think that inflation is a real threat. But again, down the road.
What that also sounds like is that you think that the Fed maybe shouldn't be cutting rates, that low rates, for as much as we might like them, are not necessarily going to get the impact that we'd hope for from a rate cut when you have a rate cut with reasonably solid economic conditions and a market at record highs. So am I wrong about that? I don't think we're not expecting them to cut rates, but would you like rate cuts or fewer rate cuts, or is more going to be better?
My own opinion is that the Fed is between a rock and a hard place right now because there's so much pressure on them to cut rates. The data on employment is getting murkier and murkier because of the government shutdown and the lack of good data. And they don't want to be accused of driving us into the next recession. So they are leaning toward cutting rates for a number of reasons. Having said that, one of the principal reasons why the government wants them to cut rates is to bring mortgage rates down, to help the housing market, to bring the rates down on the government debt so the government doesn't have to pay so much in interest every year. Right now, the interest expense annually is more than the entire defense budget. So there's this pressure to lower rates. However, what people confuse is that the Fed controls the short end of the rates. And while they might continue to cut rates, the long end might actually rise in response because they think, well, the Fed's abandoning their control on inflation or the dollar starts to weaken again. So it's really not a simple situation. And even if they cut rates in the short term, there's no guarantee that the long-term rates will go down. They might actually go up.
We had another guest on this show who was saying, and he's focused on the financial services industry, but he's like, low rates are not all that they're cracked up to be. And that's sort of what it seems like we're looking at here.
Yeah. No, I think that's true.
When you look at what's been happening with gold and hard assets, the other comparison has been Bitcoin and crypto, which people want to make digital currency. Now, of course, gold is a hard asset. Crypto is an asset that it's vapor. It's certainly not hard, yet people want it to be considered digital gold. I'm curious, how do you believe those two play together in a portfolio? Because I know you don't believe that crypto is digital gold. So how do those play together for you?
Initially, when Bitcoin was created, it certainly appears that the whole purpose of Bitcoin was to be the digital gold, the alternative to gold. It would act just like gold. It would be a fixed supply, relatively fixed supply, and it would take the place of having to deal with these physical heavy bars. So I know that was the original intent, or at least I assume it was. However, as time has gone on, Bitcoin has been not at all correlated with gold. It's been most correlated with the NASDAQ 100 index times 3. So it's really behaved very, very differently than gold. Now, does that mean that someday off in the future, it won't have an opportunity to act more like gold? Well, perhaps it will. And so ever since it came on stream, I had to pay a lot of attention to Bitcoin because I believe very strongly that all portfolios should have within them some portion that's not beholden to a central bank, that's not someone's liability, that can act as an effective hedge. For me, that's gold. And I had to really know if Bitcoin was going to replace gold, I've got to pay more attention to Bitcoin. But so far, that hasn't happened. And I, in fact, anecdotally or qualitatively, I'll follow Bitcoin more as a sense of animal spirits in the market. And when Bitcoin is soaring up and making new records, I notice all the risk assets are doing very well. When Bitcoin starts to fall off, it's almost like an early warning signal that maybe animal spirits are going to calm down a bit, and I better be careful looking at the other risk assets.
Are you at all putting allocations to crypto? In other words, we talked about the portfolios you're building and how you're doing it. Do you believe, because there are some folks in the industry, most notably among them BlackRock, where Larry Fink was saying, no to Bitcoin and no to crypto at one point, and now they're putting them in like their target date funds and what have you, and saying everybody needs an allocation. So are you on the yes, I want an allocation, no, I don't want an allocation, or individual choice in the middle somewhere?
In all of our core portfolios, where they're global, multi-asset, our investment universe is access to all kinds of equity indices, all kinds of bond indices, all kinds of hard assets. We do not include crypto in those global multi-asset portfolios. But we do have clients who have indicated an interest in crypto. And what they said was, is there a relatively safer way to invest in crypto where we might not be subject to the tremendous volatility, but just in case crypto does well, maybe we put 1 or 2% of our net worth there and just let it ride. And so we did come up with an isolated special strategy we call Crypto Plus. And for those clients, there's a home. And we do have a sophisticated model that was built that tries to dampen the volatility. But again, we tell people, it should be considered for a small percentage of your net worth, and it's not part of the overall asset allocation that we have.
You talked about how you want the allocation to hard assets because it certainly is going to help you in a world where globally currencies are moving things around. I'm curious for your take on international markets right now, because there are plenty of people who say that the strong performance we saw from international stock markets was basically a reflection of what was happening with the currencies, and that has now stabilized. And therefore, the opportunity that we saw where international was finally paying off and giving its diversification benefit has ended. And then there are others who say, no, look at the valuations. International has a long way to go because it's still cheaper than what you've got here. Which side of that argument are you on?
So the reality is that over the decades, there's a multi-year pendulum that swings back and forth. And for many years consecutively, you'll see U.S. equities outperforming all the non-U.S. equities, all the international equities. And then after several years, that pendulum will swing. And for a multi-year period, you'll see international equities outperforming U.S. And usually at the end of those periods of outperformance, you see this tremendous valuation difference. And when it really gets stretched, that's usually when the valuation swings. So ever since we recovered from the great financial crisis of 2008 and the market started to rally, starting in March of 2009, we've had tremendous outperformance by U.S. stocks. And some of that is justified because U.S. companies have outperformed international companies. Their earnings grew faster than international companies. But the problem is that it created so much momentum and so much buying, irrespective of valuation, but just to ride momentum and carry the trend, that we now have a situation where since the rally started in 2009 to today, earnings per share of the S&P 500 have grown tremendously. They're 4 times bigger now than they were. Problem is that the price per share is 10 times bigger. And we know that over any long period, these two have to equal. It's like an accounting identity. At the same time, international stocks have grown so much less in terms of price per share. And while their companies hadn't grown their earnings as much, the price relative to earnings is a lot more sane, a lot more normal and not so overvalued. So we think that rubber band is stretched very far. And like you said earlier, bubbles can last far longer than logic might suggest. So it's always tough to know when that rubber band's going to come back. But earlier, actually late last year, late in 2024, our model suggested that this was the time for swings. So earlier this year, we did allocate our equities to a shift where we have twice as much in international equities as domestic equities. And that started beginning of this year. And so far, that's been a great move. And so we think, sure, currencies have some role in it, but the valuation has an even bigger role.
Steve, I know that you guys are looking ahead. We're at that time of year where firms like yours are starting to consider what their outlook is for next year. Just broadly, as we wrap this one up, we've seen a couple good years on the market. Can we see another good year in 2026? We're going to assume that this year is going to end in pretty positive territory because it most likely will, unless something weird happens with the government or what have you. But There's a lot of people who are worried that we're at a peak and it can't go on forever. So what do you tell them as you look ahead right now?
Well, I tell them that risk in the market has less to do with volatility and more to do with how overvalued a market is, because volatility is a reflection in the short term of how noisy fluctuations are. And you can have a market that has a very low VIX or volatility measure, but all of a sudden go down very quickly. So we think that's incomplete. The way we measure valuation right now, there are three major periods of overvaluation in the last century. And we think this is one of those three. So we think the market is much more dangerous than most people will ever admit. One of the measures, certainly not the entire measure, but one of the components is the price to sales ratio. And we recently just hit a new all-time high in the price to sales ratio of the S&P 500, higher than the tech stock bubble, higher than before the financial crisis, even higher than the roaring 20s that led to the 1929 stock market crash and the Great Depression. So we were at all-time rarefied territory. It's hard to predict when means that the correction will come. It's easy to predict that when you have such a high price to sales ratio, your average returns over the next several years are much lower than normal. So we think it's a dangerous market. We have more in international stocks than US stocks. I feel like we have a finger at the trigger watching our models every day, looking for the sign that this is the time to pull back on equity risk. So we just think it's the time to be careful and cautious.
I said it was the last question, but I'm lying because I'm going to ask one more very quickly. Given what you see building, do you have a sense that whatever we're going to see, is it a blow off? Is it quick, short, and steep, but then recovering quickly? Or is this something that's going to be with us for a while?
We seem to be in what I call a market melt up, where the last phase of a rally, or you can say a bubble, is often where the sharpest gains are. And it's so hard for human nature to not want to participate. And that's what creates the sharp buying climax, so to speak. And we seem to be in that now. And when you live day to day, things don't seem so abnormal. But if you take a step back and look at the charts, it's exponential. It's going through the roof. So we think that this is a market melt up. It could continue. We have, the Fed poised to lower rates again. We have tweets that come out every time that the market needs support. We have tremendous buy the dip mentality. We have the FOMO, the fear of missing out. And so this all leads to, this tremendous market melt up. And anytime in the past when we've had market melt ups, again, they're hard to predict when they fall. It's like an avalanche. You don't know which snowflake is going to cause the avalanche. But when they fall, it tends to be sharper than what most people might believe, because you got all the leverage built into the market, all the margin buying, and then people try to run out the door the same way. So we're concerned, and we really want to watch for that.
Steve, I really appreciate the perspective. We're going to be watching it as well. We will have you back on down the line as we see how it all plays out. But thanks so much for your time today on Money Life.
It is my pleasure, and great to be with you again, Chuck.
That's Steve Cucchiaro. He is the Chief Executive and Chief Investment Officer at 3EDGE Asset Management, which is online at 3edgeam.com, the number 3edgeam.com. Remember, they just produced a white paper, Hard Assets, Essential Ingredients for Building Diversified Portfolios. You can take a look at that if you go to their website. And you can stay here for the rest of Money Life. We don't have much to go, but we'll cross the finish line together right after this message.
Hi out there in Money Life land, it's Rob Floyd, the show's executive producer, and we've got two contests this week for books discussed on the show. First up, it's Fixed, Why Personal Finance is Broken and How to Make It Work for Everyone by John Campbell, who was a guest on the show on Monday of this week. And then there's The Winner's Curse, Behavioral Economics Anomalies, Then and Now, co-authored by Nobel Prize-winning economist Richard Thaler and University of Chicago professor Alex Imas, who appeared on Tuesday's show. The subject of this week's contest is horror movies. Specifically, to be entered to win a copy of Fixed, tell us the name of the first horror movie to ever receive a nomination for Best Picture. To have a shot at The Winner's Curse, tell us the name of the first horror movie to actually win Best Picture. Send your answers to chuck@moneylifeshow.com by noon Eastern Time on Saturday, October 25th, to be entered for a drawing to win the book. And please put the word contest in your subject line. Good luck.
I hope you've been listening, not just to today's show, but to a lot of the shows we've done recently, because we are seeing some changing in the trends that we're hearing on the show. I mean, you had multiple guests today, but we've already had multiple guests this week, and we're not that far. We still got another day to go this week, where they were talking about we're not going to get the full impact of rate cuts. You heard today David Ellison basically say twice in two different ways, possibly because I didn't ask him the question all that well the second time. I think it was more on me. I led him back to the same ground. But you heard him say twice that he believes that you could have the market pull the economy into recession because they are now more locked together than they've ever been. And you heard a similar thing, but for slightly different reasons, from Steve Cucchiaro. Really, really interesting. And of course, you've got managers who have different specialties here, and yet they're drawing some of the same conclusions. Again, worth watching. And still everyone is saying, yes, we're basically inflating a bubble, ride it out till you see trouble. Nobody's saying you don't want to get in tune with it. And then you have Todd Rosenbluth today picking a super volatile play. And that's the kind of thing where if you can make that call on that kind of a fund, in my opinion, well, then you can make the call on the fact that, yeah, I think I know what the timing is going to be to make things work, or when it's going to end. To that end, remember the quote of the day, which was from Tuesday, which was, there are only two types of people, those who can't time the market and those who don't know they can't time the market, that being from Terry Smith. So, yeah. Tell you what, tomorrow on this show, we've got more great things for you. One of your favorites in the Navigators coming back to the show. That's Rob Shaker from Shaker Financial. He is a discount-driven investor. Always great conversation with him. And Dave Rosenberg from Rosenberg Research will be back here tomorrow. He's only been on the show one other time. He's a really good guest, a really good interviewer. At least he was the last time we had him on the show. But I've also seen a lot of stuff. He does a lot of media, just not all with us. And I've seen him make other appearances, and yeah, I'm excited to see what he's going to add to this conversation. Meanwhile, if you're looking for something to celebrate, well, today is National Horror Movie Day. And the way you celebrate is not by screaming. It is not by going out
looking for monsters.
No, it's by entering our contest, because our contest is all about horror movies. So you can win copies of Fixed, and you can win copies of a copy of Fixed and a copy of The Winner's Curse by entering our contest, which is about horror movies. Rob gave you the terms just before we got to this segment, but go back and listen if you need to so that you can enter the contest. That's how I'd celebrate. But also today, it's Swallows Depart from San Juan Capistrano Day. It's National TV Talk Show Host Day. It is National iPod Day, if you still have one of those. It is National Croc Day, if you wear Crocs, the shoes. I don't, but I have other shoes that I love just as much. And on the food front, National Boston Cream Pie Day.
Wow! A pie!
And in fact, that may be what Gail and I have for dessert tonight, because we are going into Boston. Gail's going to get to see, well, I'm going to see it with her, but she's going to get to see Hamilton for the first time tonight. So super excited about that as well. And I hope you're doing something fun. Meanwhile, my guests today, well, they gave us a fun show. They included Todd Rosenbluth, head of research at Vetify, online at vetify.com. David Ellison, portfolio manager and financial services specialist at the Hennessy Funds, hennessyfunds.com. And Steve Cucchiaro, chief executive and chief investment officer at 3EDGE Asset Management, online at 3edgeam.com. Thanks to them. Thanks to Rob Floyd, my producer. Thanks, of course, to Maho, my dog. But mostly, thanks to you for being here, because you make this special and worthwhile for me each and every day. The Money Life quote of the day comes from this show and Steve Cucchiaro. You heard him say it just a few minutes ago. He said this: risk in the market has less to do with volatility and more to do with how overvalued the market is. Yeah, you don't want to confuse volatility for the market's potential. And you don't want to confuse it for risk, because if you do that, you'll lose control on the money. And you don't want to do that. You want to remember, until we do this again the next time, the best thing you could do for your money is not worry too much about it. Have a great day, everybody. Stay safe and calm. We'll see you here again tomorrow.
The people who appear on Money Life are here for your and their own entertainment. Don't take advice from us or any other podcast without doing more research and/or consulting your financial advisor. We believe our guests provide reliable information, but we can't and don't guarantee the accuracy or completeness of their statements. Opinions expressed on Money Life are those of the host and guests only and reflect their personal thinking. They're not representative policy or strategy of any employers or sponsors. This show is produced by Money Life Radio, which retains all rights to the content. If you want to use any part of this show for your own purposes, be they good or evil, you must get our written permission first. And remember, with great financial information comes great responsibility. Please act responsibly.
Show is over for now.